on the. Hello, everybody. This is Abera. So we're continuing on with our annual business meeting. Today we're going to be talking about how to properly calculate capital gains on the sale of a property. We've had a lot of people sell properties last year and a lot of people reaching out this year on that calculation. So you definitely want to make sure that you check in with me before you sell a property so we can run some numbers for you. But the other thing that we're going to talk about, which we would focus on first, get that out of the way, is a day in the life of a typical real estate agent, so a real estate investor. So one of the things that we have on here from Bridget is attending real estate conferences. So for Bridget, what was your takeaway from it? And then for others that have attended real estate conferences, what are some good, bad, and uglies about attending real estate conferences? Because we all agree that we should get educated, right? There's a good and there's a bad to it. So let's talk about that first. And then we talk about other things that we do regularly as real estate investors, look at some good quality things and then take it from there. And Laurie has a question which we will address after. So Bridget, you can continue on. What were some of your takeaways from that multifamily conference?
One of my biggest takeaways was the importance of networking with like-minded individuals. By attending this event, it showed me that I can actually play a bigger game. So I've pretty much been like in the smaller arena, single family duplexes and quadplexes, but networking with other people who have done it and is at a much higher level than you gives you the courage and belief that you can do it as well too. And they're so forthcoming as far as, helping you with whatever issues that you may have at hand. And also too, to actually grow, you're going to actually need a team. So it's not something that you can actually like do by yourself. So it's important to go out to these events. You may just meet your next business partner at one of these events. And a lot of people have partnered with people who they've cultivated long relationships with at these networking events.
So thank you for mentioning that. So networking is very important. We have networking that we can do at our level, which is at least going to your RIA monthly meetings. How many people here attend their RIA meetings at least once a month? Whether you do it virtual or you do it in person, or how many people here are affiliated with the RIA? And is there anybody here who is not affiliated with the RIA? Because that's the first step in terms of networking and attending conferences. Then when the bigger ones come in, you can also participate in those. So anybody else in terms of you are part of a RIA or you attend a RIA regularly, or anybody hasn't, why haven't you? Is it something that we can help out on this call to get you, connected with a RIA before we move on? Okay, so Laurie used to attend the MD RIA at Investors United in Harford County, but that has seemed to fizzle out. Yes, I noticed that during COVID, a lot of RIAs fizzled, or something's going on with the person that started it, but there are good RIAs in Baltimore County. I started sponsoring the Real Deal Meetup with Charles Blair. He meets in downtown Baltimore. So you can look that up, Lori, or email me and then I'll connect you to him. But the Real Deal Meetup is in Baltimore. Also the Deals Meetup also meets in Baltimore as well. So there are several of them. My advice would be, if you're connected on Facebook or meetup.com, usually they advertise their meetings on those two places. So I'm connected with at least 5 here. There's the Real Deal Meetup, there's the Deals Meetup, there's DC RIA, there's the Prince George's County real estate. There's the New York RIA, there's Maria, there's the Boston RIA. So there's several. Does anybody have a good RIA in Mid Hudson Valley? For my New York people, does New York City RIA, is that near the Hudson Valley? Does that cover that, or is kind of like far? The one with what's her name, with Teresa Martin, or does she do online?
Teresa Martin is doing online still. She has all of her meetups online virtually.
Okay, so Sharon, that would be the New York City
That RIA NYC.
Sorry, RIA NYC.
Mhm.
And what I'll do, let me write it down here. So Sharon, I will introduce you to Teresa Martin. She's also a part of the wealth building company, so she's part of us. I will let her know. And then Lori, Charles Blair is also a part. So these are my industry partners. I'll also refer you to Charles Blair. Okay. Okay, and Cree said that there's a Mid Hudson one. Cree, are you able to get the information and post it as well? All right, thank you. And then there was a question that Laurie asked. Has anyone ever attended the Bigger Pockets conference? Okay. I like Bigger Pockets because it's like the Facebook for real estate investors. And I know a couple of my clients, you know, Joseph Asamoah that speaks, does, you know, regular speaking. I've written a couple of articles for them, but in terms of the quality of their conference, I can't really speak to that. So I don't know if anybody else on here knows anything about that. Okay, Sharon. Oh, that's how you found out about us. Oh, okay. All right. Thank you, Cree. So Hudson Valley, HVREIA.com. Thank you. Thank you. Thank you. Thank you. All right. So let's talk about, is there anything else in the, what else do we do regularly as investors? What else do you do during the week? So let me know, how did your last 1 week go? We talked about networking, going to conferences, the importance of that. Anybody else? What did you do? What did you do in the last 1 week? So I start calling y'all out.
I'll go. I'll go before you call me, but that's okay. I don't mind because I'm busy. So within the last week, I have been trying to get my bookkeeping in order.
Okay.
Okay, so it's not like networking or anything, but I did meet a bookkeeper and on one of the events that I went on with RIA NYC.
Okay.
And so we're working on just going from QuickBooks Desktop to QuickBooks Online. So that's what I've been working on a little bit.
Awesome, awesome. So bookkeeping, keeping your books, keeping accurate records is very, very important. I cannot tell you how many people have left money on the table because they were not doing their bookkeeping properly. You know, there's the sophisticated ones where you can do the QuickBooks, you know, like Sharon said, but there's also sample business workbooks where you can do it in Excel. So taking the time to keep records of exactly where your money is going, what you're spending money on, is a very good way to spend your time during the week. So taking the time, you know, whether it's at the end of the week or at the end of the month, going and keeping track and keeping records of what money came in, where all you spent money, what it is that you can do to minimize, you know, some of the expenses, because sometimes some of these expenses are they're monthly subscriptions, and you don't know, going 3-4 years, you forget that you subscribe to this thing. For me, I was trying to get my credit score. I didn't know that getting my credit score meant that I automatically subscribed to this monthly thing, and it wasn't until this year, and this has been since 2021, Like, oh my God, it was so annoying. And I was like, I need to start looking at my bank statements more often than I do now. So bookkeeping, so Cree does driving for dollars. Cree, can you tell us about how your experience has been? What area are you going in and why are you deciding to drive for dollars? Because you have also, can you tell us a little bit about your brokerage? I know you were not able to come on last week, but you know, Sharon did a very good job of talking about what she does. So can you tell us a little bit about why you're driving for dollars, how you're doing it, and why you're doing it, even though you've been very successful and have a brokerage?
Mostly, I don't know if you can hear me or not, but I am not someone who's done a lot of driving for dollars, but even as a broker, I don't like to buy from other realtors. So that's, I want to find deals, and the pricing is way too high right now to make the spreads I like to make. So that's a big thing. I like to make large spreads, especially with prices leveling off and in some cases coming down. I like to hedge my bet. And I found a deal for $60,000 in a market that if it was put online, it'd be 200. So I basically call out to everybody I can find. I have sweatshirts and swag that say we buy houses, we sell houses, and I put it on my trucks. I talk to people, whatever it takes, and then deals come. You know, it's about numbers. And I have various partners, and sometimes they're like, oh, there's not that many. I'm like, because you haven't knocked on enough doors. You just have to talk to a lot of people and you'll find those. I bought one from a wholesaler, which I've only done that twice before. I usually find my deals, but, and I would have paid more. I didn't tell them that, but when he sold it to me for 88,000, I'm like, you don't realize what this house is worth, tricked out. And so I gladly took that deal. And I think he made 18,000. I would have probably paid another 30 over it. So, you know, and I didn't have to do all the digging, so it still made sense. But, you know, even as a broker owner, I'm out there pounding the pavement so I can get my agents who are also investors. So we're sort of like a teaching hospital. We're a teaching brokerage where my goal is not just to line my pockets, but to build the portfolios of my agents, and that in turn, you know, brings me more deals, more partnerships, more money, more lots of things. So that giving a lot really brings it back. And it's with giving without expectation, except for, you know, I want to see my people do better than me and knock me out of the park. And that ends up doing very well for me as I get older. And at some point, maybe I'll retire, but yeah.
Awesome. So Jerry is asking whether you have people that do rehab and repair. Also, where are you located? Because I know there's some people who might be interested in thinking about becoming a realtor, since you're a real.
Oh, I got you.
Focus.
Yeah, I'm located in New York. So mostly what we do is in New York. I've done some things out of New York. I have a team on payroll, and I also have a variety of subs that and I used to be a foreclosure broker as well, but I let that go because they wanted me to renovate their properties for a broker fee. And I was like, yeah, no, thanks. I'll buy the house and make all the money. So yeah, we're located in the Hudson Valley area, Hudson Valley Catskills, which is like Woodstock, Kingston, about 90 minutes north of New York City. So it's more affordable. I used to live down in Brooklyn, and then it got real pricey for me. And, you know, I tend to be a little more conservative and like, you know, and I couldn't play with the big cats out there. So I moved, you know, was investing up, and then I liked it so much, I moved up there. So that worked out really well. But we still, as a brokerage, sell in New York City. A couple of my agents do that. So as long as we're in New York, our license, and we disclose everything, our license, you know, it allows me more overall deductions, depreciation, because I'm an active real estate professional. So, you know, that works well for us. We just disclose, and we haven't had any problems.
Good, thank you very much. Just as I'm thinking about it, I'm like, my New York people seem to be taking over. Where's my Maryland people at? Can everybody tell me what state they're located in? It looks like my New York people are on fire. I know Sharon is New York. I know Sharon is New York. I know Bridget is New York. Yay, Maryland. Yay, Washington, D.C. There we go. See? Thank you, thank you, thank you. Oh, my Maryland people are here. Good job, good job, good job. See New York, I like you guys. I was born in Brooklyn. But live in Maryland, so I kind of straddle both places. We have Florida, we have Georgia. Awesome, 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 awesome. Maryland and DC, good job. All right, born in Brooklyn. Oh, wow, okay. See, I knew we had something in common, Millen. Let's see. So let's talk about Jerry's a little bit, and then we'll move more into the capital gains calculation. So Jerry's currently dealing with a property manager who's trying to push a sale of one of their properties. And just before the call, Jerry was addressing a tenant complaint of neglect of property that the property manager should have taken care of. So let's talk about property managers from hell. I don't want to say I've had bad experiences, but the whole concept of having a property manager for me was kind of like counterproductive for the same things that Jerry is mentioning. I felt like nobody will take care of a property the way that I would. So even when I had properties out of state, I was managing them from here. And I know there's several people on here who are managing properties out of state. So it was like identifying like a really good rehabber, really good handyman, really good contractor, really good attorney, you know, and, you know, so collecting the money was easy. Taking people to court was easy. Handling the repairs was easy. I really didn't see that. I just have had many horror stories where property managers, but I've also seen good stories. So let's talk about that for a second. What would you guys advise or say to Jerry where you have a property manager who's trying to force you to sell your property rather than hold on to it? Exactly, like Laurie said, you're spending your time managing the manager. Any words of advice for Jerry based on what he's currently going through? Switch, okay. Yep, I agree. I feel like they should not, I feel like they should not be the ones telling an investor. I feel like they're just an ulterior motive to that, because as a property manager, you're supposed to help with being able to hold the property long-term. But when you start trying to push a sale, is either there's somebody else that you have, or you know that the property there's that there's somebody else, or there's something about the equity and the property, there's something else going on more than meets the eye. So for me, I think it's time to change property man. And everybody's saying the same thing, doesn't sound like he wants to manage, wants a property without any problems. Yep, find out what needs to be done, replace the property manager. I agree 100%. Thank you guys, community, for giving that advice. Jerry, I hope you will take that into advisement as you make your decision. All right, so I wrote down 4 things that we spent our time doing last week. 1, going to conferences and networking. 2, bookkeeping, so the financial piece. 3, driving for dollars, very important. There's ways that you can still network out. Driving for dollars is also still kind of like networking, but networking for actual properties. And then 3, getting rid of property managers from hell. All right, one last thing so that we have 5. What did somebody do this? What did you do in the last 7 days that you think we need to know about?
I looked at an interesting deal today.
Oh, okay. You want to tell us about it?
So the question is it
Sorry,
a deal?
Jim, when last did I see you? You're getting older. Do you remember when? So let me tell you guys about Jim. Jim and I have been friends for a long time. Like client became friend. But do you remember when I was working in Bethesda?
Yes.
And you were my client, and I was telling you some of the challenges that I was having. And Jim was willing to drive all the way to Bethesda to come meet with me, drop off his tax documents. I really, really appreciated that. I would never forget. I was like, you're gonna come to my office while I'm here slaving off. That's 2006, 2007. That's been a hot minute.
Yeah, well, you helped me out tremendously too. Don't forget when I had that issue with the IRS, and they were telling me I needed to I don't know, pay $23,000, and you got them down to 1,200.
Yeah.
So and she was a mean lady. You got me right back with her.
Yeah.
And no, that was a big help.
Yeah.
So I appreciate. I'll always be in debt to you for that. That was a wonderful thing you did for me.
No worries. So tell us a little bit about this property.
So this is an interesting situation. I looked at this property about a year ago, and then I looked at it again today because I had forgotten why I rejected it back then. But then it kind of came to light. The owner was there. It was brought to me by a friend who was an agent. She had me meet over there, and the owner was there. And it turns out I know the owner, but the owner is he's an elderly African-American gentleman in Washington, D.C., and he owns a lot. He's owned a lot of properties in Washington, D.C. And this particular property, I guess he lived in it at some point with his wife, and they moved out several years ago. He owns it free and clear, and for what I do, I buy houses, I fix them up and sell them. This is a definite developer opportunity from my standpoint, but from his standpoint, he wants to sell it to someone, and these are his words, I want to sell it to someone Black. And it's actually 3 units, and it's divided in 3 units, and he wanted them all to go to someone Black to keep them in the community, because people are currently, this community is being gentrified quickly. So I don't know how I can really help him there. And then on top of that, he wants to sell, mind you, it needs everything. But in his opinion, everything kind of works. So therefore it's good enough. Somebody can move in at a low price point and and own a nice property in a nice condo, mind you, in a nice neighborhood. This is a row house that's been turned into 3 condo units, a basement and 2 upper units. He wants to sell the basement for $400,000, one of the upper units for $500,000, and the other upper unit for $600,000. And the building has junk in the yard. I mean, it's so unsightly, it's not even funny. So the fact that what makes it interesting is he owns it free and clear. And if you were to fix up the units and really do, like, units in that same market are going for $900,000 to $1 million, condo units. But they're, soup to nuts. They've been remodeled. They're 3-4 bedroom units. The building's been expanded to accommodate that. He doesn't want to spend a dime, and he doesn't want to go through construction, the construction period. He's got this rigid sales requirement where he wants to sell to someone black, which means these realtors can't even work with him because that's, that's illegal. So I don't know really how to approach this where I can benefit from this deal. Is it a deal? It doesn't sound like a deal to me. I can't get my mind around it. Any thoughts that you or anyone else on this call might have would be helpful. And I have other information if you have any questions.
Okay, so what do you guys think? My first inclination is, I'm learning, I actually signed up for a class with John Maxwell about leadership, and it talked about attitude. And it says that sometimes in order to have the right attitude, that you need to surround yourself with positive people. And so sometimes if you're not dealing with somebody that is positive, no matter what it is that you think you may get out of the deal, it's just not positive. It just leaves you feeling funny and crazy. And, why would you say, oh, you only want to deal with one race and not the other? I don't care what your reasons are. They're just some things that in principle that you don't do. So for me, in principle, I would not even bother, but everybody has their own, everybody has to figure out what their own value systems are. So what do you guys think? Should Jim continue to pursue? I see Edith saying maybe rent to own. Edith focuses on DC. So maybe that's based on her vantage point being in DC. That's something.
Vera.
Yes.
My question to him is, does the gentleman expect to leave the property? Or does he expect, okay, he expects to leave the property.
He wants to relinquish ownership.
Huh? Okay, but how much does what's his bottom line? How much does he want?
He wants, judging by those numbers, 1.5 million.
Okay, so, but what does he need? Have you found that out?
He owns it free and clear.
No.
Not only,
I know he owns it free and clear, but what does he need in terms of money? To do what?
Does he need the whole 1.5 now, or can it be structured is what she's asking?
He said he would, for the right buyer, he'd be willing to owner finance. And also he said for the right buyer, he would be flexible on price.
Well, then
he doesn't need money.
Okay, you really do have a deal. The issue is, like Vera says, how to structure it. Okay, and you just need an amount and the time, and you really do have a deal there. I'd see how much money is involved in keeping it as one home versus breaking it up into 3 condos.
Sorry, it's already broken up into 3 condos.
So they have a
yes,
HOA docs
separately metered.
Huh?
Separately metered.
Okay. Well, it's a deal. It's just a matter of how you structure it.
Yeah, I can't seem to find a way. Like, those numbers don't make sense.
No, you have to do it the right way, figure out what it actually is worth. Then you're going to show it to him, and then hopefully get a deal with him as the seller financing.
Yeah, it's about 2.4 million if you put in about 800.
Well, it depends. To me, it depends, but I think you have a good deal.
All right, so Jim, we could possibly talk about this offline some more.
Okay, sounds good.
If you're able to, and I'm glad that kind of helps us to segue into the conversation we have about capital gains and what options you have once you know that you have capital gains. And one of those options is seller financing and installmental sales. So I'm going to talk about the difference between the two. But there's more flexibility when the person has a higher price but is willing to finance, especially in this day and market of higher interest rates or whatever. If he's willing to carry it at a lower interest rate, it might justify the higher price, but you're not having to do, or you could even do a balloon at the time that you're done with the condo conversion. So there's possibilities based on what Edith is saying and her analysis. I guess for me at my age, there are just certain things I walk away from, but I'm not saying you can't do it. And if you make the money, I'll be more than willing to file your taxes and charge you for it. But so it sounds like a deal. You have to look at it. A higher price with seller financing could be the way to go in order to get this to work. All right, so I kind of messed up I'm trying to see, okay, share screen. So let's move into this now. So one of the major things that we wanted to talk about today was how to properly calculate capital gain on a property. We'll answer all the questions for that. And then after that, we look at, now that we know what the capital gain is, what are some options for that? I've done at least 3 or 4 of those every week. I just did one today on 3 properties, and the client, their case is a little different, where the child has almost $150,000 of student loan debt at 11%. And so for them, the analysis was, if I sell, pay the capital gains tax, can I use the proceeds to now pay this off? Would it be better? Or should I keep the property and refinance? So we had to look at all these options in terms of what would work best. Speaking of which, let me stop sharing real quick, because there was something I shared with her that she did not know about. So I want to let you guys know, especially this is for those in Maryland, and I'm gonna post the link as well. So I don't know how many of you have heard about the Maryland Smart Buy program. If you've heard of it, please put it in the chat. If you haven't heard of it, this is a program that's made available to first-time home buyers that have existing student debt. So you have to have existing student debt with a minimum balance of $1,000. And what they do is that they provide up to 15% of the home purchase price for the borrower to pay off their outstanding student debt, with a maximum payoff amount of $50,000. So this is a really, really good program, you know, for those of you that are realtors out there, or have family members that are thinking about buying a home. This, you know, helps them to buy a loan while also paying off their student loan debt up to $50,000. So I posted that in the chat. You can look at it some more. There's mortgage lenders that you have to work with in order to do this. But this is a very, very good way. And they said the full student debt of at least one of the borrowers must be paid off at the time of the home purchase, and home buyers must meet all the eligibility requirements for the Maryland mortgage program. So I thought to share that, because that was one thing that I had shared with the client today. That was something to look into in terms of options, where, you know, with the next generation, if we're teaching them about, you know, building wealth and owning property, that's one way to take down that debt, is by rolling it into the home purchase. All right, so let's look real quick. The first thing that we're going to look at, let's look at this purchase section that I highlighted. The first thing is that when you are going to sell a property, you have to pick up the purchase price. So if, you know, if you're a client of ours, all of you, most of you are, all of you are, yeah, because this is the wealth building plan meeting, you would reach out to us and we would send you the depreciation report. On that depreciation report, it's going to show you what your purchase price is, and it's going to show you what your accumulated depreciation is. So your net cost basis would be the purchase price, and then you back out the accumulated depreciation from it. Because any depreciation that you claimed over the years, you have to pick up as depreciation recapture at the point of selling. In this client's case, they also had passive activity losses. So passive activity losses that were trapped, that they couldn't claim because they were not real estate professionals making over $150,000 a year, also goes towards increasing your cost basis because you were not able to claim that before. And then you look at your sales price, you can look at the fair market value, like go on Zillow or whatever place that you go to get estimate the fair market value estimate of the property. do a calculation of what the settlement cost will be. Usually we do about 10%. This one here is about barely like 9%. And then you subtracted the net sales proceeds from the net cost basis. This one here gives us capital gain of 101,000. And then we would give you what your effective capital gains tax rate is. Effective meaning federal, state, and Medicare. So if you make over, if this capital gain puts you over the $250,000 AGI, you are going to have the Medicare surcharge to pay. If you are a full-time real estate professional, you do not have to pay the Medicare surcharge of the 3.8%, but you have to pay the regular tax. The capital gains of 15% is long-term capital gains, and the state taxes, federal, and for those in Maryland. But most people, it comes out between 7 and 9%. So that's how we came up with the 30%. So for somebody who sells their property at 176,000 and they bought it, this is what, like a 7-year time frame, they had $100,000 capital gain, and then the taxes was $30,000. So they're going to be left with about 70 grand. And the question is, should I sell? You know, is this something that is worth doing? You know, am I selling because of the location of the property? Am I selling to meet my financing needs? Or because of the way the market is, this may be a good time to sell and convert my cash to something else. So I'll pause now to answer any questions that anybody has about this before we now start looking at what options do we have now that we know what our capital gain is and what the capital gain amount is and the capital gains tax. Does anybody have any questions on this calculation before we move on?
I have a question, Barry. Is it true that if you were to put this property inside an irrevocable trust, was a specific type of irrevocable trust, that would avoid paying the capital gains tax?
Yeah, so what they're talking about is the DST, the deferred sales trust, where you put the property in the deferred sales trust before selling, but you avoid capital gains. That as you take the money out, as you take distributions from the deferred sales trust, that's when you pay the taxes. What I've noticed in the 4 or 5 times that we've done this analysis for clients, it costs a lot of money just to even have the deferred sales trust set up. In one case, it was almost like $50,000. And I'm like, this defeats the whole purpose of having to even, you know, you're trying to save on taxes, but you're going to take some of that tax money and pay in the DST fee. So the answer is yes, but you do need to look at what your fees are, how much you're having to pay in order to save some. Because after we did the calculation, we're like, you might as well put that $50,000 towards paying the tax. Like this person owed $150,000. And so the DST fee was going to be $50,000. So yes, they're saving $100,000, but you're not really, you're saving it now, but it's just a timing issue because at the time you take out the money, you are going to be paying taxes. So it's more of just deferred taxes. So why am I going to pay $50,000 to defer taxes and I still have to pay the $150 at the end of the year? Let's say I even take a distribution of $15,000 every year for the next 10 years. I still have to end up paying those taxes. So what sense does it make? You know, so for me, that's one of the concerns that I had. Yes, you're able to put in more than one property into the deferred sales trust. And we do have a contact that we work with on the deferred sales trust. They'll run the numbers, run everything, give you the fee, tell you how much it's going to cost and all that. But like I said, most of the people we've done the analysis for ended up not going through with it. But I would include that as an option here in terms of some of the ways that things that you can do now that you're aware of what your capital gains exposure is. Any other question before we look into the options? Good questions, by the way. Is deferred sales trust the same as a land trust? No, completely separate. It is, as the name says, deferred sales. So it's a very, it's a land trust is a simple trust and disregarded. A deferred sales trust is a complex trust and not disregarded. That's the whole reason why you're able to defer it, because you do not pay taxes on the trust earnings until the income is distributed. That's the underlying premise for why the deferred sales trust is set up. That the money, once the money is made and it stays in the trust, as long as you don't take a distribution, you don't pay taxes on it. So the land trust is very simple. It's passed through. You can have a property in a land trust, and then any income, expenses, capital gain passes on to you. But the deferred sales trust is completely separate from you. That's why, one, it's irrevocable, and two, it is complex, meaning that the income does not have to be distributed to the beneficiaries every year. That's what gives you the ability to defer the taxes on it. Okay. All right, so moving on, let us look at some exit strategies that I have written down here. So for my clients, after we finish doing this analysis, one of the things we now look at is, does it make sense? Should we just pay the taxes and have the net cash available? I mean, you pay taxes of 30 grand, you have about $71,000, 200 left that, that you can spend and do whatever you want to do with it. For people that are retiring, that's something that is an option. You're now going from having active, where you have to deal with property management and all that, to now having a more passive investment. By the way, I forgot to make an announcement. I spoke to a client last week who they are looking to gradually start divesting their properties. And so they have 2 properties that are in Pittsburgh, I think, Pittsburgh, Pennsylvania, and they're multi-unit. And they don't want to deal with the property management anymore. And they said that they would be open to an arrangement where they do like seller financing, but I'll talk about the seller financing. So if anybody is interested in a deal like that, send me a chat, send me an email. We want to gauge how many people might be interested, so that she can start doing her analysis of how much she wants to sell it for and what kind of seller financing arrangement. Her whole goal is not wanting to be involved in the property management. Also, if you want to say, hey, I want to bring to the table being a property manager for this property that's located in Pittsburgh, it's done very well, but she wants to gradually take away that aspect of having to manage the property as they get older and the kids are going off to college. All right, so one option is to pay taxes. Second option is to do a 1031 exchange. 1031 exchange is where you're able to exchange one property for the other and not have to pay capital gains taxes. Really quickly, the requirements, you have to work with a qualified intermediary. You cannot get any money at closing. Any money that you get at closing will be taxed pro rata on the capital gain. So in this example, let's say the property sold for $176, but you said, hey, I'm going to take $20,000. So $20,000 divided by 176, that's 13.7%. So now you're going to have to pay 13.7% of this 30,000. So in this case, you're having to pay about $4,000 for any money that you take out at closing. You have to identify at least 3 properties within 45 days of closing on the relinquished property, and 180 days you have to close on those replacement properties. You can also do a a reverse 1031. A reverse 1031 is where you purchase the replacement property before selling the relinquished property. The only rule is that you cannot hold on to both properties at the same time. That was one thing that we dealt with Sharon when we talked about her doing a 1031 last week. So you cannot hold on to both properties. One would need to be put into an LLC, and then the other one would need to be held. You can do a qualified opportunity zone. Even though the sunset provisions have started on the qualified opportunity zone, you still have 3 years till 2026 when you can defer capital gains on a qualified opportunity zone. So you can type in qualified opportunity zone in your state, and you'll see the parcels, the zip code, and the tracts where you can do a qualified opportunity purchase. You have 180 days from the time that you sell your replacement property to buy a qualified opportunity zone property. This also applies to capital gains from stocks. So if you have capital gains from stocks, you can also do a qualified opportunity zone. Another option would be to refinance. Instead of selling, you can look at refinancing and pulling out some of the equity. So in this case, we're saying equity of, I don't know how much the loan was. Very important thing I forgot to mention, your loan amount, the balance, does not factor in calculating capital gains on a property. But let's say the property is 176, you owe about 70 grand on it, $100,000. They might agree to lend you about 50, 60. You can refinance and have access to that money rather than having to sell outright. But remember that whatever money you use now, later on when you sell, you're going to have to pay those taxes then. A lot of people think that, oh, because I took this money out, refinance, you have to subtract out the loan amount that was paid at closing. No, you're going to have to pay taxes when you eventually sell the property. Then you can do seller financing or installmental sale. Seller financing is where you sell the property outright and you take back a note. What we encourage you to do is an installmental sale. So Jim, this is what we were talking about earlier, that if this guy agrees to do an installmental sale, with an installmental sale, you sell the property gradually. So as they pay down the sales price, that's how you pick up your capital gain. So in this example, the property was sold for 176 and the person pays you $20,000 every year. So every year you're paying taxes on just the $4,000 of capital gains and not the whole 30. So it gives you a chance to smooth out your capital gains tax rather than paying it all up front. With seller financing, when you sell and you take back a note, you pay the whole capital gains in the year that the property was sold. So you're better off doing installmental sale than doing seller financing. And the last one that we talked about, which we kind of mentioned, was doing a deferred sales trust. Again, the property is transferred into a trust. The trust sells the property, gets the money. If it's not, as long as it's not distributed to you, you don't pay taxes until you take a distribution. I discourage it because of the fees that you have to pay in order to have that trust properly set up. So these are some exit options. Once you figure out what the capital gain tax is, then now you see whether it's worth it or whether to look at any of these other options. So I would open it up for question. Let me stop sharing my screen. All right. Okay, so I have somebody that's indicated interest in the Pittsburgh property. I got you. Can you refi first to get your cash tax deferred? Yes, you can refinance, because that's what I was explaining, that when you refinance, you don't have to pay any taxes. But remember, refinancing is kind of like taking your capital gain ahead of time. So when you take your capital gains ahead of time, when you eventually sell, you're not going to have those capital gains. I cannot tell you how many clients think that the way that you calculate the capital gains is that you subtract the loan amount, like whatever it is you got at closing is what you're paying taxes on, the net cash to seller. No, the loan amount does not matter. So if you refinance 10 years ago and pulled $80,000 out and you sell the property later on, you're going to pay taxes on that $80,000 that you pulled out before, plus whatever additional equity that you had in the property. So refinancing is one way to defer it, but eventually you would have to pay the tax. And so you don't want to be surprised when it happens. All right, somebody asked me how many units. I think it's like a 3 to 4 units that this person, I'm trying to, because the way that the property is listed, you know how they say like 100 to 104? So I don't know if it's a multi-unit or if it's just a block of properties that are sitting together that they have, but we can discuss all those details, you know, when I connect you guys. All right, do you have a contact on how to set up the paperwork for that? I was thinking of selling a property and taking back a note. Yes, this is a much better option. Laurie, I'm not happy that you didn't talk to me about selling a property and taking back a note. We did not do an analysis. We need to do an analysis and come up with that. So just give yourself a little slap on the wrist. I'm not taking advantage of the Wealth Builder program, but this is something that we need to do. But just send a quick email. Let's do the analysis. And figure out options. Okay, I'll let it slide. So you attended the business meeting. That's why it's good to attend business meeting. So the contact is really just the real estate attorney. They are the ones that would set up the installmental sale for you. So set up the contract so that it's not taking back a note. They set it up as an installmental sale. Where is this property located? If it's in Maryland, I'll refer you to Attorney Gross. Okay, Florida. Let me find out. Hold on. Let me find out some of the Florida attorneys, or if you have a Florida real estate attorney, you can email me and copy them. Usually, like if you have a title company that you're dealing with over there, email them, copy me on it. Hey, I'm looking to do an installmental sale. Is this something that I can answer any questions that need to be answered? All right, Sharon said, I spoke with a lawyer who said it was really risky to do owner financing with the economy going south. All right, so let's talk about that. With the economy going south, the worst that can happen is that they don't pay and then you foreclose and then you get your money back and start it all over again. I don't know if you guys know that sometimes doing rent to own is one way to get more income on the property, because some people are never able to close on their rent to own contract. So when you have a rent to own contract, the person, they put money down, either they're paying more rent, like $300 every month, but they have 2 years. If they don't, or they put down a, what do you call it? They put down the deposit, the option, the lease option deposit. It's forfeited if they don't close. So for me, it doesn't matter for me whether they default or not. If they default, I simply foreclose and I take back my property and I'll have some money left. So I don't know, let's hear other opinions. Laurie and I are kind of like on the same page. Anybody else have a difference of opinion from Laurie and I in terms of whether this is an issue?
I just want to clarify. I was thinking the same thing. Maybe it's the case that New York has particular laws, but this lawyer was saying that in the event of a foreclosure, in this case, there is some kind of external officer that is assigned to foreclose on the property. So I wouldn't be able to. Determine what the sale price was. So my property might be sold for a lot less than I want it to be. That was the danger. Is that the
that sounds very strange.
Yep.
That they're gonna foreclose, because the whole thing is that you foreclose and the property comes back to you before you now decide whether you want to sell or not. You're just getting the title back. Okay, so let's do this. Let me copy. Okay, so the main thing is that a third party can force a sale on a foreclosure. What I'm gonna do, the RIA NYC president, Teresa Martin, who is also a wealth building planner, I will send her an email and copy you, Sharon, to see what her response is. Since she's an attorney in New York, she might be able to answer that question for us. But it sounds very strange that a third party would be able to just sell if you don't want to sell and you just want back the note. So I don't know if anybody else has heard anything, but I haven't heard anything like that on my end. once you get a judgment, it goes to auction. Does it have, can you get a judgment where you take the property back? Like you as the owner buy back the property? Or does it have to go to auction? Okay, so once you get a judgment, it goes to auction. Okay, so I will post that question to Teresa and see what response she gives us. All right, any other final comments, questions on capital gains or everything we talked about, a day in the life of an investor before we round up? Any other topic? We only have one more meeting and we're done. This has been very fruitful. Any other topic you would want me to cover next week? I think next week it's kind of like open where we kind of discuss whatever. So if you have a specific topic, please let me know. Okay, so Cree says that for bank properties is a pain to foreclose in New York. Okay, so maybe this is something that's unique to New York, foreclosing. So thinking about seller financing if you're in New York. All right, any final comments before we wrap up? Any topics you want me to cover next week? Okay, so if there's anything open, it's open. So of course, between now and next week, because some of these things I cover is also based on what's coming out of the business meetings with clients. So thank you guys for coming. Okay, syndication deals, okay. You can always email me if you think about anything between now and then. Jim, what do you mean by investment strategy? Estate planning and trust.
Just like what are different investment strategies? What are people looking for in terms of ROI?
Okay.
What's and what, like, I know we're in a quote unquote declining market. So what's,
Kind of like the guidelines for Mayo and
better.
all that.
Yeah, that's right.
Okay, so Mayo and best practices. Okay. All righty, guys. Well, thank you and have a good rest of the week. I know I have a meeting with some of